Hi Ryan, what has been going in your life recently that you expected and did not expect?
Hey there. Like I like to say, haven't really been any surprises recently, which is always a good thing. Everything's been status quo with me, my family, my children, my business, um, and uh, and that's where I'm at right now.
Okay, so when you acquire a business, what are the goals you want to achieve when you buy it?
I've actually never acquired a business myself. I've started Think SBA. I have just in general that everything else is equal, meaning, it's the right business for me. The business has upside. The business has strong recurring revenue stream, profitability, et cetera. But the number one goal for me when I look to acquire business is cash on cash return. So, for example, my target is a minimum of a 100% return or a one-to-one cash on cash return. So, for example, in year one, if I put in 100,000, I'm able to receive back 100,000 within 12 months. I recently had a deal structured that did not materialize, but I would have seen a positive 100% return. So that would have been through working capital. So if I put in, let's say 50,000, I was going to get back 75,000 in working capital.
So, how do you identify these potential sellers, business brokers, investment bankers, trade associations, or professional networks? What is your choice?
So for me, being an SBA loan broker, I see a lot of businesses, and sometimes what happens is sellers will actually contact me and refer me to a buyer. And what happens occasionally is that buyer won't be able to perform. And then at that point in time, if the seller doesn't have any buyers teed up and it's something interesting for me, I'll mention, hey, maybe if you're open to it, I'd be interested in looking at this business as an individual. That's one way. I also have listing brokers who I have relationships with. I will say that though people who aren't in the industry don't really have an option to work with listing brokers they don't know. I would say that if you are a searcher looking to acquire a business, that you do a lot of research on the listing brokers. It's been my experience as someone who's looking to acquire a business, but also as someone who represents a lot of buyers, that I would say, just in my experience, that most of the listing brokers I work with, um, let's just put it in a nice way. Let's let's say maybe they don't have the business acumen to actually be an honest, responsible listing broker, and so because of that, there are a lot of times where deals will fall through and not materialize, not finally close. For example, I was working with an individual. He was referred to me by an M&A advisor here in San Diego, California. This individual had several businesses he was reviewing. The first business that he was reviewing fell out because the listing brokers and the sellers had colluded to hide certain expenses in the profit and loss statement. He was able to discover these and then not buy the business. Then the second time it fell through was because the key employee was being held in the background, but came to the forefront. And then once the key employee did identify that they wanted to buy the business, then the listing broker and the seller both told my borrower that they were not going to sell the business to him. And so, because of that, I would say that the first thing, in my opinion, is to, if you're going to work with listing brokers, would be to research and develop a relationship with a listing broker, so that you have a high level of certainty that you can trust that listing broker.
And what do you say about professional networks, like a mastermind, for example?
Yeah, I mean, I think you could find a business anywhere, right? I have worked with several individuals that have been a part of masterminds, and they think that they're a really strong place to source opportunities, and primarily because, again, I'll give you another example. There's an individual who contacted me that I met with, and he's a computer programmer, but he wanted to get into ETA, entrepreneurship through acquisition. So he joined a mastermind, and in doing that, he was joined with other individuals who have been there, done that. So they'd already acquired businesses, they'd already acquired real estate. And what they were able to do is lead him down a path that they had already gone, and also provide him with the resources he needed to ultimately execute on that path. And so um, all of those different types of paths to find a business, I think, have their own positives.
So, if you're acquiring a business and you want to dominate the risk if the business fails, what strategies are you going to implement to make sure that this business produces enough cash on cash return?
So in looking at acquiring a business, the first thing I would recommend to anyone, and this is what I do, is I do an assessment of my strengths and weaknesses. So it is very important to be self aware of who you are as a person. I'll say that it's not impossible, but it's more difficult for younger people to be self aware. I know it was more difficult for me to be self aware. When I say self aware, I mean, again, knowing your strengths and weaknesses. And so when I look for a business, and if people ask me my opinion, I'll recommend to them that they look for a business that aligns with their strengths and weaknesses. And typically, not always, but typically, strengths and weaknesses are also aligned with what bring you joy, and what you find burdensome. So I can tell you that the things that I'm strong in typically bring me joy, and the things that I'm not as strong in is because I don't find joy in those things. So that would be the first thing I would say, would be for someone to be self-aware who they are, what are their strengths and weaknesses. And then next, I would flip it onto the business, and I would look at the historical performance of the business and look at how that performance has either been consistent or not consistent through different periods of time. And again, that's where an individual who has several years of experience or is older will have an advantage. For example, um, did you live through, were you cognizant of 2008 and 2009 downturn in the United States economy? Was that something that you were cognizant of? How old were you then?
I'm 14 years old.
You were 14 years old. So, so just like you, there were times in my life, for example, in the 80s, there was the savings and loan crisis. I hear people who are older than me talk about the savings and loan crisis. I have no idea what the savings and loan crisis was all about, because um, I was around, in my teens, my early teens in the late 80s. So that's where someone who's experienced, who's a little bit older, who remembers downturns in the economy, will be able to draw on their experience and memory when assessing a business to buy. And so for me personally, businesses that I'm looking to buy would be local. That would be San Diego, Orange County. Um, I'm looking to buy a business that is in the tourist or hospitality industry, that serves individuals coming to San Diego and Orange County to enjoy our weather, our beaches, our cuisine, etc. And I believe that that falls within a strength of mine. I do have a background in hospitality, and I have a desire to serve people and to give them a great experience. And so, one day I will acquire a business that falls into that particular industry.
And what is the human psychology behind the seller's mind? They do want, whether they want to retire or they want a high price for their business or they want a good operator. Most times it's retirement. And so, what affects them the most in these three cases? Either they want to avoid the stress embedded in the business. So, what affects them the most? Either they want a good operator or the high price. for their business?
So, from my experience, again, like you highlighted, right, some just want to retire. Some are interested in just, hey, I want the highest price. Some think about their legacy, and some think about post close, how their business will move forward and how the buyer will treat their employees. What I find from my experience is most people are just ready to retire, and getting the most money is what's important to them. They do obviously place a value or premium on the buyer being able to successfully operate the business and also the way they treat their employees. But I would say that I experience fewer sellers who put post closing performance at the top of their list. I would say that most of them want to exit the business, receive the highest amount possible for the business, and that post closing performance of the business and treatment of the employees would be below obtaining that high price and exiting the business. Um, and I think the reason for that is because the sellers realize that when they do exit the business, even though they want the best for the business, they want the best for their employees, they also realize that because it's highly unlikely they'll be involved with the business beyond what's acceptable to, for example, the SBA, which is up to 1 year, or some of them don't even want to be a part of the business at all after the business is transferred, that since they're not in the day-to-day control of the business, it's best to actually let go of the business and put that in the trust of the buyer.
So, how much flexibility can they provide in these three cases during negotiations?
And what do you mean by that question?
I mean that are they willing to adjust the price?
Are the sellers flexible?
Yeah,
Are they willing to adjust the price? So
absolutely.
it's my experience that they don't like to adjust the price unless, and the unless here would be unless they are persuaded by a business valuation that the price should be lowered. But I would say in most cases, in fact, overwhelmingly in most cases, the sellers are not open to changing the price. Instead, what they would do is provide a higher seller carry note. So, for example, if it was determined that the value of the company was less than what they wanted to sell for, instead of decreasing the purchase price, they would increase the seller carry note. And so doing, they would be remunerated the full purchase price, though they wouldn't necessarily get compensated at closing for the full purchase price that they requested. So that way, over the long term, they will be remunerated the full purchase price. And that would be a concession that would have to be made by the buyer, essentially saying, I want to buy this business so bad, I'm willing to pay more for it. But the seller would then in turn take more risk in terms of carrying a higher seller note.
So, what is your communication strategy with the seller?
So typically so I'm not a listing broker. So I'm an SBA loan broker. So most of the time I'm working with the buyer. There are times that I will work with the seller. Again, sometimes the sellers contact me directly via Google, my podcast, or sometimes I'm referred to the seller by their M&A attorney. For example, if a listing broker is not involved. And so I'm working with one right now where a friend of mine who's an M&A attorney has referred me to the seller. I'm pre-qualifying the business, and then I'll also pre-qualify the buyers once the buyers are presented to me. What I like to do when I work with a seller is again, like you had mentioned, understand their goals and objectives, both from a performance perspective and then also from a timeline. So I'm working with one seller right now. He was referred to me again by a friend of mine who's an M&A attorney. And this particular seller is extremely interested in the post-closing performance of the business. And that's primarily because his son is currently a key employee in the business, though his son doesn't want to buy the business, but he does want to remain a key employee of the business for a few years. So this particular seller is very interested in the post-closing performance of the business. So that's where I understand the goals and objectives of the seller. And then the timeline, this particular seller doesn't have a timeline and is really interested in entertaining offers and waiting for the right type of buyer. In this particular case, he's looking for a strategic buyer instead of a buyer coming from outside of the industry. So somebody who's inside the industry who is looking to roll up, quote unquote, other businesses in the industry, which would mean that the buyer would be an expert in his business from day one, be able to incorporate his business into the existing business of the buyer, which would give, in his mind, his business the highest ability uh, to be successful post closing.
So, what problems are most likely to arise after the business acquisition, and how will you handle those problems?
So the first problem that can arise is that what you've been told as the buyer is not true once you're the operator. And believe me, this happens all the time. It doesn't happen every time, but it happens frequently where sellers will misrepresent certain aspects of the business. Now, what's the recourse of the buyer? They could sue, right? But, you know, again, litigation is never a guarantee. You have to prove certain things, and that would be a huge distraction as far as the conversion or the transfer of the business as a buyer. That would be a huge distraction to go right into litigation. So yeah, the biggest risk is that when you actually begin operating the business, it's different. It's different, possibly operationally, in revenue or profitability, just because unless you purchase a quality of earnings report or a full financial audit, there's really not in any checks and balances to the integrity of the P&Ls. You would hope the tax returns would be accurate, but believe me, in this business, rarely are the tax returns accurate. Rarely are the profit and loss statements and balance sheets accurate. Unfortunately, most business owners that I've known do not place a premium on good record keeping or good bookkeeping. There are even some that will tell me right off the bat, I have two sets of books. I have a set of books that the IRS sees. I have a set of books that are real. So I've had people actually tell me that personally. I'll give you an example. So I've worked with an individual who acquired several landscaping and pool contracting companies. He's a Columbia graduate, London School of Business graduate, private equity, brilliant individual. He acquired a landscaping company to bolt on to his pool contracting company here in Southern California. The first
Okay.
day he stepped onto the grounds at the landscaping company, there were zero employees there. They had about 10 employees. There were zero.
Oh,
Everybody had left after the acquisition was closed. So there were zero employees when he showed up to a business that he bought with employees. Now, I think most business owners at that point, most buyers would have failed, and he would have, his loan was over $1 million. I think most business owners would have failed. Honestly, I mean, that's pretty hard to come back from, where you buy a business that's fully operational and then day one you step foot and there are no employees there to execute the vision. But because he already had an existing company, he had existing loyal employees, what he was able to do was draw on a couple of the employees in his pool contracting business and quickly get up to speed with the landscaping business. And within 6 months, he was exceeding revenue and profitability of the business that he bought. Again, I attribute that to the fact that he had existing businesses with existing employees. and that he is brilliant and he bought a business that bolted onto his business perfectly. But that is something that, though, again, that's a rare occurrence, I think. That is something that buyers need to be aware of, is that when they actually receive the keys, so as to say, and they are now the business owner and operator, anything could happen. You could get hit with a right hook that floors you to the ground. And you have to prepare yourself before the transfer of the business to be able to withstand any and all curveballs that might be received.
So when you acquire a business, how long-term vision do you acquire for the acquired company? I mean, what is your exit strategy?
So, really, the exit strategy depends on, in my opinion, the overall lifestyle and economic strategy of the acquirer. So, for example, I just saw someone put out on X this morning that there are private equity individuals who are leaving private equity and buying businesses that they can operate just because of the autonomy. So, that would be a lifestyle consideration, correct? They just want to own and operate a business. They don't want a manager. They don't want a business overlording on them. They want to be in control. So, that would be a lifestyle decision. Um, those who have a lifestyle decision probably aren't thinking of the exit right away. They're thinking of just, hey, I'm going to be the boss. And they're happy to be the boss. And then they'll think about the exit strategy later. Now, there are others who are much more strategic, and their whole purpose for acquiring a business would be to roll up that business, meaning acquiring other like businesses, aggregating them together, driving the revenue and profitability to a place where the multiple really starts to make a lot of sense to exit. And then when they reach that particular goal, then they will sell. So I think it really depends on whether someone is buying a business for lifestyle or if they're buying a business as a part of a larger roll up and exit strategy.
Okay, so let's put you in a situation. If the seller carries a note of 80% of the transaction price and demands the 20% to be the down payment, and if the business fails and the business is not able to generate the enough money to pay the seller, what are you going to do?
I mean, if the business fails, I mean, that's a really big if, right? If the business fails, I think that there are only two possibilities. Number one, I, as the acquirer, didn't do my due diligence, or the seller lied to me. Those are really the only two options, right? So if I didn't do my due diligence and I wasn't able to pay the seller, and just so you know, so in an SBA loan, for example, typically they're structured where the SBA, well, always structured where the SBA is the senior lien holder. So the SBA is always to be paid back first. And then typically the SBA provides a runway before the seller even starts to be paid on their seller note. And so that safeguard is put in there exactly for what you're asking the question, so that the buyer off the bat doesn't have to pay back the SBA and the seller. So there's usually some runway there, some breathing room for the buyer so that they're not put into that situation. Now, just to answer your question, if that is the situation and the seller has lied, then what recourse do you have? You might be on the, if you can't just pay, if you could pay the SBA but not the seller, I think you just negotiate with the seller and just say, hey, look, this business isn't performing. Determine why it's not performing, and then say, hey, you know what? I'll pay you when I can pay you. In that case, if you have an SBA loan, the seller, in my opinion, and I think this would be meted out, though I'm not an attorney on the documents, but I think that in most cases, as long as you can pay the SBA, the seller really has no teeth in the short term, as long as you're paying the SBA loan to litigate. Again, I'm not an attorney. That might be wrong, but that would be my opinion on how these are structured.
So have you ever structured a no money down deal?
Have I ever structured a no money down business acquisition?
Yeah, absolutely.
Yeah, well, for example, right now I'm structuring one. It's a business acquisition of a key employee who is buying a business that he has been general manager of for 15 years, and he's receiving 100% of his down payment from a relative who refinanced their house to obtain equity to give to him to inject into the business. So it's not that it's a zero money down, meaning there's no money into the transaction, but it is zero money out of his pocket because he's receiving a gift from a parent. So there have been numerous situations where individuals have not put any of their own money into the transaction, but money has been put into the transaction. I closed an in-home healthcare business in Los Angeles with two individuals who each put 2.5% in. So we had two partners, 50-50. Each of them put 2.5% of the purchase price into the business, and the seller put in 10%. So in that particular case, they actually came out cash on cash positive the day they signed the loan because the working capital was more. The working capital they received was more than the actual cash they injected.
So, what is your favorite moment thus far today in your career?
What is my favorite moment in my career? You know what? That's a really introspective question. And I would say my favorite moment, I'm just going to say this. If you go to my Google reviews, you'll see it. There were two individuals referred to me. The reason why this is my favorite moment is because I was referred to two individuals who were never more perfect for this particular scenario, and never wanted it more than two other people than I've met. So they wanted this so badly, and they were perfect for it. Let me explain it to you. So I was contacted by my CPA about two individuals who wanted to buy a property in Northern California. It's a hospitality property on the ocean, extremely unique. Again, if you go to my Google reviews, think SBA reviews, you'll see that they've left a review photograph so you can kind of find out what the place is. But they were referred to me, and in their own words, they had been turned down over 40 times by the time they got to me. And let me tell you why they were turned down 40 times. They were turned down that many times because they went to banks and lenders who weren't the right fit and who weren't looking at the business acquisition correctly. So this was covered land meaning the business was on top of the real estate and they were going to buy both. So the business, incidentally, never cash flowed ever compared to the cost of the business that was being sold. And the reason is because the value of the land itself, the real estate, was 95% of the purchase price. And because the land is right across the street from the Pacific Ocean, you can imagine that it comes with a high price tag. The individuals who owned the business before it was sold to my clients purposely, so listen to this, they purposely did not earn the maximum amount of income or revenue the business could have earned. And the reason is because they wanted to keep it slow and just quaint. They didn't want it to be overrun with people, so that the individuals who came to their piece of property had this really quiet, peaceful, calming, tranquil location to come to. So they purposely did not operate the business to maximum revenue. And because of that, obviously the cash flow never met the standard necessary to buy the business. So the reason why most of the lenders said no is because they were looking at this primarily as a business acquisition and not as a real estate loan. So when they came to me, I was on the phone with both of them, but really Chris was the man, and his wife was in the background. I was on speakerphone. I didn't know that. But Chris asked me, "Hey, Ryan, do you think you can get financing for this?" And I said, after listening to him, I said, yes. And I came to find out later that his wife was listening, and she was actually mad at me when I said yes because I gave her false hope in her mind. Short story is we closed it approximately 60 days later, like I said we would. And it was because the lender I chose was a real estate lender. And so they understood that even though the value of the real estate in the business was X, that in a liquidation scenario, the property would actually have a lot more value. And then the second thing is that Chris, he's an expert in operating hospitality properties. So he operated properties with an enormous amount more complexity in terms of individuals coming to the property, in terms of the number of habitations or dwellings on the property, et cetera, et cetera. And so the bank essentially said, we know that Chris can operate this and we love the real estate. And so even though the property had never cash flowed, the loan was approved on a projection basis and they're meeting their projections and they're doing well and they're happy. And so that's why that's my favorite moment in my career, because these people were literally at the end of their rope. They had nowhere else to go. Everyone else had said no. They came to me. I was able to provide the financing, and now they're a happy couple living in Northern California, making other people happy.
Ryan, are sellers opposed to separate the real estate price from the business transaction that happens between the seller and the buyer?
Are they opposed to that?
I,
Um, so that's a really good question, and that is an area that I find myself in quite frequently, because in fact I just was on the phone with an individual yesterday who will be buying the real estate in the business. And so here's something to consider as far as that's concerned. So your question was related to an individual buying a business where the real estate is also owned by the seller, and if the sellers are opposed to selling the real estate with the business. And here's my answer to that. I have found in my experience that it's completely dependent upon whether the sellers need an annuity from the rent of the real estate, or whether they'd rather have the lump sum and then just ride off into the sunset. Also, in this particular case that I'm mentioning, where I was speaking with the buyer yesterday, he told the sellers that he would not buy the business without the real estate. So I don't find all the time that sellers are opposed to that, but I would say a lot of the time sellers are opposed to selling the real estate because they do see it as an annuity. So for example, let's say you're going to sell your business for $2 million. You're sitting on the real estate. You've paid the mortgage off. Now it's free and clear. You can charge a market rate for your lease, and that can act as a monthly revenue stream for you in retirement after you sell the business. I would say for most people, that would be optimal, right? Because they're not taking a lump sum, paying taxes on it, if they do pay taxes on it and don't 1031 exchange it. So I would say that most, in my experience, are opposed to it because they want to keep that recurring revenue stream for themselves in retirement. Um, I refer to that as the second exit. So when an individual owns a business, again, it's highly recommended that they own the real estate or that they buy the real estate from which the business operates, because that gives them the flexibility of making that choice and decision after they sell the business, which is the second exit. The first exit being when they sell the business, the second exit being when they sell the real estate. So just to recap, a lot of sellers will keep the property, the real estate, as their second exit because of that ongoing revenue stream. I work with an individual here in San Diego. He's a listing broker. And what he does is he's a commercial real estate listing broker. And what he does is he works with people selling their business to determine whether it's best for them to sell the real estate or to keep the real estate. And there's some complex analyses that go on in that particular situation that he helps sellers with.
so, Ryan, the closure. Does a business mean risk to you?
Does a business mean risk? Absolutely. I mean, there's so many risks involved. That's why I think more people don't buy businesses because, again, some things that we've talked about, right? So when you're buying a business, really you're buying a business that even though you've done due diligence, you don't necessarily know everything about the business. You don't really know the top line revenue unless you do a really good job of dialing in the revenue from statements, et cetera. The profitability, again, I've seen so many profit and loss statements and balance sheets that I would say that you don't really know the profitability until you get in. So I'd say there's a lot of risk, but here's the one thing that mitigates risk, and it's not cash flow, because cash flow ebbs and flows. And even though banks really like to see businesses that only improve their revenue and profitability or cash flow, that's usually not the case. Cash flow usually, again, ebbs and flows. But the best way to mitigate the risk of acquiring a business or owning or operating a business is cash, not cash flow. So building up a treasure trove, or a savings account that, again, just like in our personal lives, right? We need to have a safety net. We need to have a savings account that we can draw on just in case we need it, quote unquote, for a rainy day. Owning a business is definitely risky. Acquiring a business that someone else has operated for several years is definitely risky. But the best way to mitigate that risk is to have cash on the sideline ready to deploy for a rainy day or a difficult situation. I practice this in my personal life. So when I started Think SBA, I had 1 year of cash on hand. If I would not have closed one loan or earned $1 of income, I had 1 year of runway where my family would have been perfectly fine. We wouldn't have noticed any change in our lifestyle. Um, and I think as a business owner or someone acquiring a business, especially for me, I'm going to look at, okay, how much cash do I have on hand to mitigate the risk of acquiring this business? So I would recommend to anybody buying a business that, in order to be able to sleep at night, in order to be comfortable with that acquisition post close, that they build up a strong savings for that rainy day. Now, my threshold is probably a lot higher than most other people, but for me, when I would acquire a business, I'm going to want a minimum of 1 to 2 years of cash on hand to pay every bill in the business and personal, so that I don't have to worry if we have a few slow months or weeks, whatever. Now that's just me, but I would think that if anyone said, well, I got 3 months worth of liquidity, to me, that would just scare me to death. I would not be able to sleep with 3 months. For me, the minimum is 12 months, but more likely would be 24 months.
Okay, so Ryan, I totally agree with your points. It was a pleasure talking to you.
Yeah, thank you for
Glad you
having me.
shared.
Yeah, I appreciate you. Thank you for having me, and you have a great rest of the day.
Thank you. Bye.